12 months of runway, but still not where we'd like it to be. So the blended runway here it's sitting at 14.2 months compared to the 18 months that we're recommending. And so actively talking to the founders about ways they can find to extend runway and make sure they've got the time to see this storm through. Capital efficiency of growth, as you know, is a pretty key metric that we look at for the companies. And so this has improved slightly year on year. And again, credit the founders in terms of both being able to grow, but also not having to raise as much. And then the total value of the portfolio over invested capital is up from 1.6 last year to 1.7 at the end of the year. We've had 8 up rounds for the companies and just 1 down round. But I do anticipate, per the earlier slides, that as companies are forced to raise money and need to raise money in a tough environment, that we may see some incremental down rounds this year as companies look to get themselves fully financed and get that 18 months of runway in place. Before I pause and jump into questions, I just want to give a couple shout outs to some specific founders that have done some really hard work this year. To the Julie and Renee at Gentrio, some really awesome news. They actually grew 284% year on year in a tough year, and just got selected for Global Demo Day, which they did with Morgan Stanley. And it sounds like they've got some extra new news to share with us today, which is amazing. I know Michael Sissions from CareerList, has been a very good steward of managing his business, but it's been a very tough environment. If you remember, CareerList is focused on the hiring side. Obviously, when companies are hiring, that's a great business. When companies are shrinking their payrolls, it's a tougher environment. And on top of that, he had to navigate a little bit of SVB challenges through the weekend, and we were texting, through that and trying to navigate it together. Thankfully, I think in a much better shape today, but still a pretty big scare over the weekend. Sarup from Senso is also, fighting tirelessly. I think he's in Denver today with customers, not able to join us. But, unfortunately had a large customer contract, $1 million contract get pulled back recently. And so these are just some of the bumps and grinds that I think all of our companies are dealing with. Listofin had a great shout out from CMFG recently this month in terms of their venture capital arm and celebrating the work of Sam, which is amazing. I also want to recognize what Dan Sherman has been able to do for the investors here on the call. Game Club has now returned back to the investors now almost 70% of the invested capital. So a very tough situation where the company wouldn't survive, and no return would have been a complete loss. And 100% because of Dan's tenaciousness was able to get the company sold, but not only just sold with some milestones, but actually realizing those milestones and getting cash back to our investors here. So I just want to thank him for those efforts on behalf of all of us. And
we just I'm proud to announce we just crossed today marks 1 year since the acquisition happened. So by the end of this month, that percentage number will be much closer to 100%. So thanks for the call out, Chris.
Dan, again, like those earnouts are never automatic. So thank you for working hard for all the investors here. It's much appreciated and very noticed, especially in this environment. And I guess
I'm as happy as everyone else.
Well, I know it's those things don't happen by accident, so I just want to recognize it. And then lastly, we were hoping last year, and I think it's also worthy of note, In Market would have been our first IPO. The company had filed confidentially to go out in early 2022. It would have been a great returner for us, but unfortunately, capital markets, continue to be basically constrained. So the company continues to perform, but just wanted to update the investors here that that the company is still filed confidentially, and when the markets open, we still believe that that'll be a strong opportunity for us, well capitalized. But unfortunately, I don't expect near-term liquidity. So with that, I'm going to stop sharing my screen and see if there are any questions on anything that I've shared.
Yeah, so it's Renee. And thank you, Chris. So our big news, so Chubb, which is a major insurance agent, but they have so many different facets of their business. They're now going to be employing Gentrio across 4 different groups. One of them is them prepaying for Gentrio licenses, which is a fantastic opportunity. And then they were so impressed and so excited about what we've built that they are taking their third party that runs a lot of this actually wants to work and co-partner with us on a number of things as well. So that was our big one for Chubb. And then we picked up a couple other credit unions and others, and then been doing really well in the insurance world lately. So we'll keep going down that path. Yeah, no, Chubb is huge.
I know you guys, you're working your tails off. So congratulations, first of all.
Yeah,
that's
and
awesome
then
news.
the Morgan Stanley lab too. I should throw a shout out to them, but we were part of the Morgan Stanley Innovation Lab, and it was a remarkable experience. Julie and I would definitely have never walked so much in New York City in our lives, but it was a lot of fun. So Morgan Stanley is doing a pilot with us, and so the Morgan Stanley, it's first at work and then E-Trade, and so hopefully that works. But the best news is that the gentleman who heads up their partnerships for all of the different wealth and segments, Teo, he's was our advisor during that, but he's actually coming on to the Gentrio board of directors, and his whole job is to make sure that Morgan Stanley uses Gentrio wherever possible. So that's a good thing too.
That's awesome.
And
Congratulations.
then I wanted to actually make one other point. So Morgan Stanley, the program that we went through was what was 6-month program, where they invest a bit of money in us, and as well they also help with partnerships and give you mentors, etc. They're actually running that program again. So if you know of anyone who would be interested in applying, feel free to reach out to Renee or I, and we can help hook you up with that, because again, huge opportunity, and they're accepting applications now.
Awesome. And I think you guys were a couple of stories high. Your images were up there on Times Square on the NASDAQ big board. So that was pretty cool to see too.
Okay, yeah, it was really funny, but then people could turn it into funny memes and send it back to me. I'm like, ha ha ha. My HBS section thinks they're comedians in their spare time. So, and then shout out to Bob too. Bob actually taught at the Morgan Stanley group as well on some of the productivity things, because one of the things that everyone was asking about was how do we ever live our lives, run companies, do all this stuff. So shout out to Bob too.
Right on.
But by the way, when you do something like that with Morgan Stanley, does that preclude you from trying it with B of A or Merrill Lynch or any of the others? And does it help you that you've done it with Morgan Stanley? Does that lever you?
Yeah, so I actually have a call today at 3:00 with Citi Ventures, because Citi saw all the Morgan Stanley stuff. That Citi Ventures was like, well, we need to know more about you and figure this out too. And then we specifically were very careful to have all the Morgan Stanley things written so that we didn't have to do things just with Morgan Stanley.
Excellent.
I did want to give 2 of our founders here an additional shout out. So Evan, great to see you. And that saw some really solid growth for SignalWire last year over the prior year, and I know that's hard won. So congratulations on that growth. And I don't know if there's anything you want to add in terms of your lens on the year ahead before we hand it over to the guys that have been through a few wars.
Yeah, sure. Thank you so much. Yeah, no, we had a good year. It was like everybody, it was a tough one, right? There was some ups and some downs, just depending on the way the market was going. Um, Contraction in telecommunications was more of a flattening for a little while. But what's interesting in that this sort of forward-looking economic environment, with the rise even of things like ChatGPT and sort of this automated tooling, you see a lot of that shifting into automated help work, which means that they need to build systems that use APIs to automate a lot of their communication stack. And so we have people coming to us even more so now than ever before, asking for, ways they can hook up, messaging and phone calls and even video chats like these into those kind of systems. In fact, I just got back from Mobile World Congress in Barcelona, where I had a conversation with the CEO of Deutsche Telekom and their board of directors about working with them. We have actually, as a quick side note, in the last fall, Germany passed a new telecommunications Privacy Act, or they passed last year, but it went into effect. And the Deutsche Telekom lawyers' interpretation of it was that no telecommunications inside Germany can pass through a hyperscaler that's domiciled under a foreign government. So they can no longer use Google or Azure or AWS to run any telecommunications infrastructure for the near term. So they came to us asking, SignalWire, can you guys deploy your stack on an EU-based hyperscaler? Because Cisco can't do it, Mavenir can't do it. And so we fast-tracked legal through that. So that was October they came to us, and by December we had it up and running, and they're using it today. And so that was part of the conversation, was how do we keep moving that forward and increase that sort of line of business? And that's also coming from Australia, Canada. More countries are passing these privacy laws. Really just the great momentum going into this year, and some really, everything from those big company telco style things all the way back down to just product-led growth, where folks are coming in and asking for stuff and using it. So we're excited about all of 2023.
Awesome to hear that optimism, so that it's not just all the doom and gloom that I did the framing on. So appreciate all the efforts. It was interesting that Bill, when we were kind of chatting before we got going, was chatting about we're talking about COLA clauses in supply chain supply agreements. Which we'll jump into in a second. But I did want to bring Dave Merrill on, both to congratulate Dave on a phenomenal year. I think over $2 billion now in back orders, if I've got that number roughly right, for Elroy Air. So amazing by any mark. But Bill, you talked about only big companies like Boeing having those kind of things. Well, Dave's trying to build a lot of planes this year, autonomous ones, and so that, I think we'll get into that conversation in a second on impacts on inflation and on supply chain. We'll circle onto it. But Dave, I don't know if you're able to give a quick update on Elroy, or if Dave's otherwise.
Yeah.
Yeah. Okay. Great.
Can you hear me?
Yep.
Okay. Yep. Great. Yeah, it's been a big year. I think the traction that you mentioned is pretty much all in the past year. Like we went from having some marquee customers with MOUs and LOIs that were unquantified, in 2021 and before, to quantifying it and getting them to tell us how many of our Chaparral autonomous aircraft systems they thought they would use. And so that took us to now more than 900 of our systems in demand in MOUs, LOIs. The quantification actually adds up to about 3 billion now, partially because we got a few more quantified, but also we're kind of inching the order price up, the standard price. So it's a big backlog that we can be working through for years. In January, one of the new things is we started to get deposit backed orders, which is a big deal for our industry. There's this cohort of aerospace companies building new systems, some of them air taxi for passengers, some of them doing other stuff. And so starting to get deposits that are backed by, or starting to get orders backed by deposits, is a real big deal. So that was with a lessor called LCI that owns a fleet and leases a fleet of aircraft out to operators that may not have the cash on their balance sheet to just buy the assets outright. And so they act as this important piece of the ecosystem, kind of making aircraft assets available to operators, which are ultimately going to go out and use them if we're not, for those use cases where we're not going to be the operator operating the systems ourselves. So that was a big one. We just got awarded another defense contract. So we work with the Air Force. Air Force has this group, Agility Prime, which has become the go-to place within DoD for new electric and hybrid electric aircraft like ours. So this group, Agility Prime, just gave us another contract focused on our hybrid electric powertrain. And they're going to be supporting and kind of tagging along as we build the more productized version of the turbogen, the turboshaft generator that we have powering at the heart of the aircraft. So that's good for two reasons. One, it shows that the Air Force is continuing to be enthusiastic about our system and wants to use it. So they're helping support these developmental steps as we get the system ready for prime time. And then it also gives us a phase 2 contract that can provide the platform for a much larger, what's called a StratFi, a strategic financial increase. So it's kind of like a plus up that's part of this Air Force funding capability, where they could do up to $30 million of non-dilutive funding, provided that they have a matching commitment from private investors. So we've got kind of the foundation of that with the latest phase 2 contract. And then in the next quarter or two, we're going to be putting together the proposal for that bigger StratFi, and hopefully we get that 30 million of non-dilutive. So, and then on the technical side, we have our aircraft out, the first one out at Byron Airport, which is our flight test facility out in the Central Valley. It's about an hour and 15 minutes from headquarters. I'm sitting in South San Francisco now at our main headquarters. So Byron is a hangar that we've got where the first aircraft is out and going through ground testing. And I'll be sharing out some materials, finishing up writing an investor and advisor update, but send out some pictures and videos of some of the stuff we've been doing to get this aircraft ready for flight test. And so it's gone through the full balancing of the vertical rotors. So they're all now individually shown to be kind of tuned up and balanced. We've spun all the rotors together. The next thing this week or early next week is going to be bringing that system still strapped to the ground, but so that it's not ready to fly it quite yet, but almost. And so we're keeping it strapped down, and then we'll bring everything up to full power. And then as soon as the software is ready for that first flight of this vehicle, then we'll start to take it up into flight test. And so that's within the next few months. So on that technical side, that's going to make it for an exciting year. And then we're aiming to have a number of new contracts in the Air Force and other defense contracts landing. Looks like, macro, the U.S. discomfort with China is really creating a sense of urgency in the DoD that seems to be good for us, that we've got more contract opportunities popping up in front of us than we've ever seen. So we're going to try to capitalize on that and bring in, one or more substantial contracts in the next quarter or so. And then as we go and flight test this vehicle this year and into next year, we will be starting to produce. And so the aim is that by the end of next year, we've got the first system out deployed with the Air Force, and then the production getting started behind that, so that we're delivering more and more systems into 2025.
Thank you for the update and awesome progress. And I thought it was a nice sort of jumping off point for the conversation with Bob and Bill, because as I think about your business, an amazing backlog of now $3 billion worth of orders, but now you've got to figure out a supply chain where supply chain's moving globally, as well as inflation within that supply chain. How's that affecting upstream customers on both inflation and interest rates and their liquidity? Maybe and I think you had to deal with SVB too, as I recall, over the weekend, and trying to make sure you had access to your cash. So a tricky time to be leading a company these days. But with that framing, I'm going to hand it over to Bob to give us his thoughts on sort of the macro environment on liquidity, what happened with SVB, Credit Suisse, and just as a reminder, Bob not only teaches at MIT, but was deeply involved in global financial markets for most of his career, including advising the SEC at one point. So I think a good guy frame sort of global liquidity dynamics for us and inflation. And then I'm going to bring it back to Bill Austin. If you were running a company these days, how would you be thinking about navigating these crosswinds? So guys, again, appreciate the time. And with that, Bob, your thoughts.
Thank you, Chris, for the introduction. And let's say my thesis is that markets until very recently this week were predicting that the Fed was going to start cutting rates this summer. That's what the futures market was implicating. But I didn't buy it then, and I still don't buy it. The CPI, as we all know, was up annual rate about 6%. If you exclude food and energy, maybe 5.5%. But that's way above the Fed's target of 2%. And it continues to be high despite a lot of the factors which people said were driving inflation have really diminished. I mean, as people have shifted away from goods into services, first of all, the supply bottlenecks, a lot of them were reduced so that people could get these products. Second of all, we had women returning to the workforce almost to the levels pre-pandemic. They had left the workforce in great droves. Third of all, energy prices are quite down, annually down 5%. Fourth of all, used vehicles, rental cars, which were really driving a lot of the inflation, they're down 13% annually. And I think it's fair to say that the housing boom, that bloom is off the rose as people now get back to normal and mortgage rates really start to bite. The question is, why is inflation still high? Well, one reason is food is still very expensive and has been growing the price has been growing above 9%. The second thing is there's no way of getting around it. The Ukraine war sort of sets a floor on energy and food prices, and I don't see any likelihood that that's going to be resolved in the next year. Third is wages for workers are now roughly 6%, growing at 6% a year. And wages are traditionally what we say they're sticky downward. They don't come down. Once they come up, that's pretty much it. And then we've reduced the amount of cash for individuals because we're no longer having these big handouts. But the corporate handouts are just about to start. We have the infrastructure bill, the CHIPS bill, and the so-called Inflation Reduction Act. Those are really throwing money at the corporate sector. So that's why you had Jerome Powell suggesting before Congress that he was thinking of raising rates 50 basis points rather than 25 basis points, because inflation is still very high despite all these positive developments, and the fundamental underlying factors, some of them seem to be here to stay. Now, the question is, what's the impact of the SVB crisis? We should all realize that there were no loans at issue, there were no credit defaults. This is very much unlike what happened in 2008. They had an incredible increase in deposits, some of which were required. They wouldn't make you a loan unless you had your deposits there. And they put them into longer-term treasuries, creating a fantastic mismatch. Just to give you a sense of this, I looked up what the average yield on 10-year U.S. treasuries was in 2020. it was 0.89, less than 1%. 2021 average yields was 1.45. 2022, 2.95, and 2023, 3.69, and it reached as high as 4% at the beginning of March. So this was an incredible increase, and so that on a mark-to-market basis, they had huge losses at SVC, and they didn't hedge. They didn't have a risk officer for 9 months, and they didn't do the basics, and neither did the bank supervisors, because if you're holding that sort of mismatch and rates are going up very quickly, you're really in trouble. And of course, the accounting of this is very unusual. If you have held to maturity securities or even available for sale, it doesn't actually hit your capital. You're allowed in held to maturity, you don't mark them to market all. And available for sale, you put them in this very unusual account called the ACI, accumulated investments. And that accumulated account is where people started to look, and they saw that what those numbers looked like. And so then as people saw more and more, they realized that if SVB had to meet deposits, they would have to sell these treasuries, which had used losses, and that's what caused the run. I should emphasize that the yield curve even now is still inverted. As of March 15th, the 2-year treasury was down a little to 4.63, but the 10-year is 3.5%. So we still have what we call an inverted curve, which traditionally has been assigned that we're going to have a recession. So what are the implications here? Well, one is, I don't think you have to worry about your uninsured deposits. Actually, SVB had about almost 90% of their deposits were uninsured. So that's clearly another risk factor. We don't see that in any other bank. We don't even see that in First Republic, which is holding mainly high net worth deposits and also has lots of mortgage loans. It didn't put their deposits in treasuries. So I don't think you have to worry about that. And then the Fed has now opened its loan window, and it's doing this on very generous terms. The banks have to put up collateral, but they're allowed to put up collateral at face value, not at mark-to-market value. So if you're holding 10-year treasuries that have a 20 or 30% unrealized loss, you don't put it in at 70, you put it in at 100. So I personally believe that this is a bailout any way you look at it. The Biden administration is saying it's not, but it is, because we're basically bailing out all uninsured depositors. We'll see. I mean, the shareholders of SVB did get wiped out. We'll see what happens at the holding company level. The holding company is SVB, has not declared bankruptcy yet, so we're not sure. First Republic is probably the other bank that's really at issue, but they're in much better shape than SVB. I assume that they'll be sold. They won't be able to raise capital, but somebody will be quite interested in their list of customers. And unfortunately, as Chris is emphasizing, this is going to make liquidity a lot harder. There are going to be these banks that cater to startups for new loans, helping them with IPOs and other things, services. So that's going to be a lot harder to get. And this whole crisis reinforces the role of JP Morgan and Citigroup and Bank of America. So people will move all their deposits there, and they'll become even more dominant. Last thing is, some people say it was a 2018 law in Congress that is the culprit because that law changed the definition of systemically risky from over 50 billion to over 250 billion. And I think SVB, when it went down, was about 212 billion. But I don't really think it's a question of legislation. I mean, the Fed has the right and should be looking, and so should the FDIC, at the mismatch, the duration matching of any book, especially when you have a bank with such huge treasury holdings and where they're matching short-term deposits, uninsured deposits against long-term assets. So they were trying to maximize their profitability and their spread. Hopefully all the executives will lose their bonuses and get clawed back, but we'll see. I'm going to stop there and turn it over to Bill.
All right, Bill. So you're a CEO, CFO of one of our portfolio companies. What the heck do you do in this environment? What are you thinking?
Well, let me just agree with Bob and add a little more fuel to what Bob said. Having been a black-hearted banker for a little part of my career, one of the foremost things that you do, other than having a chief risk officer, is have liability management that is a little more conservative than what these guys did. So the idea that they went long on the curve with that much money is just a staggering failure of the management out there. So I agree with you. I also agree that when I look at, and I did a few numbers, much like you did, Bob, looking at inflation, and people take out the inflation for energy and foodstuffs, but if you look at inflation that normal people look at, which is in the foodstuffs, so the CPI, and people look at the current, well, we're up 6% or 7%, but if you look at it over a 2-year basis, the CPI index is up 14%. And when you do that with the people who have to make a living day to day, maybe they're not on this call, but that really hurts the buying power and is the reason that Jerome Powell and the people at the Fed know they have to lick inflation, and they will go about and do it. So I agree with all your comments. And just to put it in perspective, inflation's up, cost of capital is up, cost of debt is up, liquidity is down, and as you point out, as you look at these the regional banks, of which we're all I have money in regional banks, and all, they're gonna pull back on their lending. As they pull back on their lending, I'm not sure there's going to be any more Silicon Valley banks that are going to put money out like they did. And I agree that wasn't what killed them, but those guys would lend money that we used to look at in the banking world was equity and get a bank return. Again, it didn't kill them; their liability management did. But I don't think you're going to get too many other people that are going to act like Silicon Valley in the near term. So then going back to the question that Chris really asked me, and that is, and I will point out, when you're looking at supply chain, I think we had David on here that talked about the contracts he's getting with the Air Force. And as you look at in the aerospace business, I did a tour with a big workout of a company called McDonnell Douglas. And one of the things I learned at McDonnell Douglas was when you enter into these contracts, especially for airplanes, large ticket items, you do have COLAs and you do have things in there because whether it was pricing of commodities or COLAs in general, you can bury those in your contracts, at least on the aircraft. when I deal with our companies down here in Texas now, we've been hit, and it's a little bit different than some of the stuff that you're describing in Silicon Valley. We've been hit a lot with cost of fuel, cost of specific, and what we've done in a lot of cases, we put surcharges. And when you really get banged up, you can, again, different markets, you got to have customers that'll take it. But that was the only thing that we could figure out in terms of some of the inflation that we were hit with here recently, is to add some fuel surcharges, which, by the way, have all reversed, and you got to give it all back now. So the idea of figuring out how to handle inflation in most of the businesses that I think everybody here is in, I don't know exactly how to do that. I will also tell you, though, that as you look at these businesses, and I've been through a few bankruptcies, some restructurings and all, and Chris has been pushing on this. The key is, the runway that you talk about is liquidity, liquidity, liquidity. Stay close to your source. If somebody's willing to give you money, you take it. I can't tell you the number of times that I've been with entrepreneurs that get awfully proud of their value, and to the detriment that they wait too long. And the key for all of this stuff is survivability. And to the extent that you've got anyone willing to put money in, sure, you negotiate, but in the final analysis, and I've done it with several of the companies down here, if somebody is willing to give you money, you take it. Chris, other things you want me to cover?
Yeah, so just for those that aren't familiar, because some people haven't even thought about inflation, little known, like, when you say cola, are you going to give me an RC cola, or like, what are you talking about, and what does that actually mean in a contract?
Well, going back in the aerospace side, a cost of living agreement, but generally a COLA in some of the union contracts have COLAs, and that's generally to protect union wages. But in contracts that you have in the aerospace, you put in some definitions on certain kinds of materials that can go up, and you can get returns on that. So you can tailor a cost of living, a COLA, to basically anything that affects your supply chain. Now, again, in the technology side, most of the stuff that affects, I would imagine, the supply chains that you have of people here are personnel. And it is, I'm not sure I've cracked the code of how do you put in a COLA type benefit for, hey, it costs you more to hire an IT guy. You can discuss it, you can talk about it, you can try to hit with, well, heck, you look at some of the restaurants around here. Like I'll go up to Denver, and what you see in the restaurants up in Denver is they hit you with a 2.5 to 3 to 5% tax below the line, because it costs you more money to hire people. I was a little stunned at that, but that's one way. I just,
So
I think it's out there.
Yeah, just throw one out for consideration. So Tom Jenkins, who's founder chairman of OpenText, we had a roundtable with some founders up here recently, and sort of exciting for him. OpenText is now the 7th largest software company on the planet. So some big growth, largely through acquisition, just to give you a sense of the size of the business. But he said one of the things that he did back when inflation was a challenge, and it still exists in all of OpenText's contracts on their pricing for their product, has an automatic COLA adjustment. So if Renee's out there saying, it's $100 for an online will, when you sign up, and there's a, it's a renewal fee subscription, $100 a year to kind of keep that online will, in place. If in the verbiage it says there's a COLA clause in the pricing such that if inflation's going up 5% every year, that it goes from $100 last year to $105 next year. Most consumers aren't, and most customers don't necessarily index on that. And when you've got a business that's struggling with costs going up in unpredictable ways, that increase in price that you embed in your contract actually saved OpenText many years ago, when they were dealing with inflation and couldn't necessarily manage the cost that well, but they had this automatic increase in their prices to their customers that was just kind of built into the contract that really saved them from a cash flow point of view. So that was one idea I hadn't heard of before.
Well,
Interesting.
Chris, the other side of that is to make sure that if you have contracts or whatever language you put in there, you do not commit to that $100 subscription fee annually for the rest of the contract. So if for no other reason, if you put a COLA in there, that's great. But the key is make sure that you have a chance the next year or the following year to say, you know what, to renew, it's no longer 100, it's 105 or it's 110, and you have a rationale. The last thing you want to do, which is the other side of that coin, is to lock yourself in that contract renewal is locked in stone as long as you're a subscriber. So at least you have a chance to do something about it. Of course, your solution is better, but sometimes you can't get that in there.
Yeah, and Tom was also clever to say that the COLA clause only worked one way.
Yeah.
Only if inflation goes up does price go up. If inflation's actually negative, there was no negative consequence to pricing.
Well, I having dealt with people in this part of the world, it's interesting. Contracts, well, and you all don't deal with much of this, but contracts, when you go long in some of these businesses, and I can speak to some of the energy business, you can go long with a customer and you can lock in prices and do this. And at some point, if the market turns and they can get a better price, you know what they do? They come back and say, that contract, we're not going to honor it. So, it can be tough out there when you're dealing with really big customers. Because in the final analysis, the really big customers can turn that contract on you. Now, I don't want to be too negative about it, but we certainly have seen that in some of the businesses that we've done down here. That you'll lock in a long contract, and then when the worm turns, all of a sudden they say, well, you can try to stick with that contract, but we're just not going to use you anymore. So.
Yeah, and I think maybe that prompts another question. I was going to bring Dave into the conversation a little bit, but I think for 30 years, most startups got to a sense of not having to worry about Silicon Valley Bank or not worry about their deposits, right? Like the bank went through 01, no problem, went through 08, no problem, some issues, but the idea that Silicon Valley Bank would go from getting a clean bill of health from the regulators mid-December, fine through January and February, and then 2 weeks into March bankrupt, I think really shook a lot of founders in terms of, if you think about your bank partner as a key supplier in running a business, that happened quickly. So I guess in this environment, I'll throw it back to both Bob and Bill, but you think about your suppliers of all kinds, whether or not they're banks or suppliers. Bob alluded to the Ukraine conflict. Dave alluded, I think, in the positive sense about what's happening on China and driving business opportunity in. But on the other side of that, a lot of supply chain dependence on what's coming out of Asia. How should founders navigate a lot of moving parts over the next 12 months? Like, can I count on a supplier from China? How stable is the banking environment? And a little bit Bill, to your point, like if I've got a contract with my customer and they're a lot bigger than me, maybe they don't honor it. So I'll bring that maybe back to Dave, a little bit of how you're navigating that, and feel free to change or modify the question back to both guys.
Sure. Yeah, and I'm actually sitting here with our CFO Grant Newman also. So aim the screen over here so we can kind of answer this one together. We've been keeping supply chain from China out of our product anyway because we've got this defense application for our drones. So, that's like the first checkbox that we get when we go to the DoD as a customer is like, have you excised everything from China out of the supply chain here? So that part isn't a big deal for us because it's already done. We have had other suppliers from Europe or other places where things are taking longer in the past year, like a lead time of 4 months turns into a lead time of 8 or 9 months on certain components. So that's just happening to everybody. And then I guess let me toss it to you, Grant, kind of how we're thinking about banks for ourselves going forward.
Yeah, obviously we would like to diversify. That candidly, we are struggling a little bit with the fact that just because our lender is in default, we cannot default on our credit agreement that we have with them. So we are trying to navigate that situation. We have set up other bank accounts, but now that is it's sort of unclear what the status is until that loan portfolio is either sold off or what. How we can navigate those covenants.
Does your loan agreement require that you keep deposits at SVB? Yeah, that's true of a lot of companies. I don't know how that can hold up when they're put into receivership.
I don't know how they can. I would think that the government needs to just make this sort of agreement not be feasible going forward for any bank because of this type of situation. But yes, we have to have the vast majority of our cash and our banking relationships, including credit cards, with them as part of the venture debt loan, which is obviously very important to us, but that situation is now untenable. It's unclear what we can do about it right now. We have set up some other accounts. We believe we can use one outside of that for payroll, but any other bank accounts would have to have a control agreement, so basically a reach-in for SVB to the outside bank. So while the cash is freed up, our transactions are flowing freely again, kind of backed by the full faith in government trust at this point through FDIC/SVB. It's a question of how do we get out of this situation in the medium term.
Do they still have an open line to you that they have to advance more funds to you?
We do not have a revolving credit. We just simply have a $5 million loan.
Well, I'm sure you have to talk to your legal folks, but I would think that keeping those, I think this was what Bob was implying, keeping your agreement by keeping money in there, I would imagine that's not they can't do that in this environment, I wouldn't think. But
we believe that. I agree with you. I'm not sure that the legal interpretation backs that yet.
Interesting.
But pragmatically, what we're hearing is that SVB is probably not going to be, or whatever SVB becomes, they're not going to come after clients who transferred their money out and suddenly have now become in default of their covenant. They're not going to try to penalize them for that. They're just going to try to encourage them to bring that money back.
Yeah, the CEO on his call basically said, yeah, don't worry about that. We'll waive that if you come home, right? What's unclear is if in the aftermath, you're moving that and continuing to be in breach, if they will take a harder line or not.
Some of the other big banks that we've got an account set up with Citi, we've got an account now with JP Morgan. So that's kind of, we're figuring out the balance strategy going forward, assuming that we won't be.
I think a lot of it depends on what happens to SVB, whether they get sold. At the moment, it doesn't look like they're going to get sold Because
Well, but even if pieces, right, if they were to sell the loan portfolio chunk and someone else is now the administrator, obviously then that breaks the connection between where our cash is held and who has our loan.
well, this is the best thing that ever happened to Citi and JP Morgan, no doubt about it.
Absolutely.
Someone imply, Grant, have you thought about just moving and refinancing the venture line and moving the cash?
It's
and
certainly our consideration set. We, I don't. In the last 5 days, we have not figured out a new lender. There are some prepayment penalties associated with that, so it wouldn't, there would be some friction costs, but it's certainly something we're going to look at.
The prepayment penalties are on a percentage basis. Does that add 2 points to the cost of the loan, or
You already have all the proceeds of the loan already?
Yes, it's fully drawn.
Yeah, I think the deposit requirement is probably unenforceable now.
That's my thought. I don't think it's enforceable.
Yeah, but I don't think I wouldn't change your loan terms because you got the proceeds. So I would keep the money, keep repaying it on whatever schedule you have, and I would gradually move your deposits away. And I don't think they'll say anything.
Yeah, no, I think that is broadly our plan. We just want to make sure we don't have any, now that we have.
I understand.
We don't want a foot fault.
Yeah, I agree with Bob. I can't imagine that they could enforce that. But Bob, what do you think that the Citibanks and the JP Morgans of the world are going to be aggressive in doing the same kind of loans?
Oh no, they'll take the deposits, and they have, but they're not gonna be making these loans. And as you said, in a sense, SVB was an equity lender. I mean, they were a lender, but they took warrants, and that's always been in the gray area for banks, whether that's really a loan or whether that's really should be at the holding company level as a venture capital equity investment. So they fudged on that. They got away with it. That's not what brought them down. No, JP Morgan and Citigroup ain't going to do that. And unfortunately, I don't think anybody else is going to do that.
No. You look at the regional banks, and the other interesting thing is I'm sure you're a student of that. The big too big to fail banks in this country probably have 50 to 55% of the market. In no other, like in Europe, the too big to fail probably have 95%. In Canada, they probably have 95%. It's only in the United States where they have this regional grouping of banks that frankly makes the system in this kind of environment, makes our system more at risk than what you have in Europe or Canada.
I would also, Dave, I would check out Schwab. I mean, if there was anybody who was Schwab has been hit unfairly, in my view, because the deposit business is a sideshow for them. But they may be more aggressive. If anyone's going to fill the SVC hole, it's probably somebody like Schwab. First Republic is fighting for its own life, so it's not going to be able to do anything. But Schwab has been historically a little more entrepreneurial.
That's interesting.
Grant, Dave, I'll circle back to you guys offline, but I was on the call with SVB to almost 9:30 last night, helping a couple other founders navigate out. So for you to think about, my understanding is there were 5 different bids for SVB's loan book. Once they got into diligence, all 5 deals stopped because the quality of the loan book relative to the economic environment and the liquidity crisis that we're talking about, nobody wanted to step into it. So to Bob's point, the likelihood of SVB getting acquired I think is lower today than it certainly was on Monday or Tuesday. So I think they're going to continue to be in a funky state. I have been successful in basically having TD and CIBC, both Canadian banks, but with meaningful venture debt portfolios in the U.S. Refinance SVB out and basically pull the cash and the venture debt over. So I'll reach out to you guys and make the connections there. And
Okay.
We
Do you think, Chris, is that the move then? If nobody buys the loan book from SVB, is that we just refinance out and try to get somebody else to adopt the same terms that we have?
I think the risk on the cash side, obviously, with the FDIC making the guarantee goes down. I think that the uncertainty is at some point the loan book's going to have to get sold. I just can't see the FDIC wanting to continue to run the bank, which means it'll get sold at a discount, and then whoever buys it is going to try to basically get rid of anything that they think is risky. And if it's separated, to Bill and Bob's point, from the cash deposits, the risk of the loan being called on you goes up.
Mm-hmm.
And so,
Chris, if you go back to the days of Bear Stearns and Lehman, the banks that went in there initially wanted a discount, and there was a hue and a cry. JP Morgan, I think, finally got one, but I assume that the banks that came in to look at the Silicon Valley Bank portfolio, they'll put a bid in, but it'll be 75 cents on the dollar. And I don't know that the FDIC or the regulators, or what? Yeah, okay. I don't think they can stand that kind of notoriety right now.
Yeah, so I think the risk of staying there right now, if you can find a successful refinance and move, and I get that may be tricky too. That venture debt piece of paper, can you get that moved and not take a huge haircut on doing it? But it's probably worth exploring those options. So we'll get the connections to both TD and CNBC over to you today.
Well, the real risk is if the FDIC decides there's a good bank and a bad bank, and if you fall into the bad bank, all they'll try to do is call loans and liquidate, and that would be a disaster for the capital community.
Yeah. Hey, before we leave, Elroy, Dave, Grant, good to see you guys. And I know we're trying to raise a little bit of capital right now, just kind of as a backup plan, just to make sure we've got enough working capital while you're building things. You know what? I'll talk to you offline, but you just sparked me an idea of some venture debt people. Chris, I might call Patrick Lee. I don't know if you've talked to him for a while, but just some near-term venture debt might be helpful as well. I assume you guys are open to that.
Is Patrick still out in the valley?
Yeah, he is.
My wife's cousin.
Oh, okay.
Small world.
But
I'll give him a call.
He only has one problem. He's a damn Canadian.
But we like them.
We're everywhere, Bill.
Kim, happy to learn more. Let us know what you learned.
He's good guy.
Dave, Grant, any questions for Bill or Dave from your perspective?
No, I think we need to understand that risk of the call, right? Because we have capital. We're obviously trying to shore that up and raise a little bit more, but it would be painful to us if someone said, "Oh, you're part of the bad bank," and the bad bank then had the rights to call our loan. And candidly, I need to talk to our lawyers a little bit more to understand what the risk.
Does your loan agreement say that you're callable?
Not that I'm aware of.
We got to check.
Yeah, in that we just had a review done by Cooley, and they didn't point that out as a risk. So, I'm going back to them now that we've got to talk through this a little bit. But
I'm sure you don't want to hear this, but you've got you've got some competitors out there. You've got some of the big players. A strategic investment with your kind of backlog, I'm sorry, I would think you can get a strategic investor to put a little money in you to help bail out a $5 million loan. But again, I don't know all the financials, but I know the aerospace. I used to know the aerospace business. I don't know it now, but I can't imagine that there's not a strategic out there that wouldn't want to put some money into you. You may not want them, but I can't imagine you don't have it.
We're certainly going to look at that, but what we didn't want to do kind of was react and do something. There was silly offers going across this weekend that didn't make any sense. It was, way too big of a haircut. It was people reacting out of fear. And so I think we played that right. We're in a position now, we have some time to figure this out. And so we're going to look at those options.
We have some strategic investors already, like Lockheed Martin and L3 Harris are already on the cap table. And Lockheed actually sprinted over the weekend to stand up a line of credit for a couple of their portfolio companies who just needed some liquidity quickly. And so that's something that if we needed it, I think they'd stand up and extend to us too.
Yeah, we were sort of in the bucket that they determined we didn't need immediate cash, but we were in the if something comes up, we'll stay close and can figure something out. But yeah, the situation resolved itself that we don't need anything immediate.
The other platitude, and it is a platitude, is that when credit gets tight, when liquidity gets tight, the people who have it get pretty rapacious.
Yeah. But one of you mentioned earlier, kind of when there's money available, take it. I'm a former banker too, and very much believe in that. So we're following that truism now as well.
Chris, I'm going to have to go. I'm going to have to go in 5 minutes. I don't know whether there's anything more.
Yeah, Bob, I think we may be kind of running this conversation to its logical conclusion, but I wanted to, before we lose you, Renee, Evan, anybody else have any questions for either Bob or Bill? Or any other folks on the call? Tricky environment, to say the least. Bob, before we lose you, one last question. What's going on with CSFB in Europe? Any thoughts on sort of the broader macro globally on banking that we should be thinking about?
Well, I think they're going to be bailed out by the Swiss bank. All depositors, everybody's bailing out everybody. So, and actually, if you look at the European banks, most of the deposits are, it's very highly concentrated. They don't have banks like SVB. So I think their risk is actually pretty low. Credit Suisse has been a problem child for quite a while. And I think this is just part of that. So, but, I don't think the European banks, I think there won't be a failure like SVB because there isn't anything like it there.
Hey, Bob, I was going to ask about First Republic. Any thoughts on them?
I assume they'll get sold. They still have a pretty good book. They don't own a lot of treasuries. They own mortgage. They have home mortgages, jumbo mortgages, which on the one hand are not, they don't have an unrealized loss. On the other hand, they don't have a lot of liquidity for their book. It's a very attractive franchise. And I would think that if people are given enough time, they will do the due diligence and somebody will buy them up. It'd be a very smart thing for somebody like Schwab or TD Bank to buy First Republic.
JP Morgan extended a huge line to them right in the last couple of days. So they're probably sitting in the catbird seat there.
Technically, the Fed hasn't announced that it will ensure that it will back all uninsured deposits, but it's hard to see them not doing that once they've done it for these two banks. So I think First Republic is not going to, people aren't, they'll gradually move away, but there won't be this desperate surge because the Fed is signaling it's going to back those deposits.
Well, I'll just do one last historical reminder since Bill brought it up. I remember Bear Stearns got bailed out and effectively bought by JP Morgan. And it was 6 months later that Lehman Brothers failed. And because they was pressure not to do another bailout, let Lehman collapse, which then triggered the whole collateralized mortgage crisis that hit the market pretty broadly. And, say collateralizing mortgages, what the hell has that got to do with tech? Well, sadly, a banking crisis in nothing that had to do with tech ended up being a big problem in tech in 08. And this one's a little bit closer to home with SVB. So I think being cautious and to use Bill's words, if there's cash, take it. It's a good way to finish the conversation today. But again, I just want to thank the founders for a lot of hard work in a pretty tricky environment. Big shout out to Dan and getting capital back to his investors, Renee and Evan. Nice success last year. Really awesome to see. And Dave also awesome progress in Elroy, and we'll follow up later today on some of the things we talked about. And we might get Grant connected to Bill. Might be a good connection there too.
Appreciate that.
Okay, thanks, Chris.
All right,
Thank
thanks
you, Chris.
everyone.
Bye.
Thank you.
Bye.
Thank
Bye.
you.